You're on mute, Callum.
Thank you, Melissa. Morning all. Thanks for joining us again. I hope a lot of you stayed on for mid-wind, and a few more joined. I think if you did, you might find some certain interesting aspects from here. We're joined this morning by Peter Hewitt from the BMO managed portfolio, which has two distinct share classes, so growth and income portfolios, which are quite distinct from one another. One thing they do share is an approach which emphasis on identifying strong management teams with identifiable and replicable processes. And Peter looks for these kind of things which he thinks lend themselves to long-term outperformance. Apart from being a Hearts fan, he's displayed a lot of good judgment in recent years, and returns have been very strong. So I'm going to hand him over to him to talk us a bit through the trust, how it's structured, and where he's looking right now. Just a reminder again that there is a Q&A function if you want to submit questions throughout, and we will have time for some at the end. Thanks very much.
Callum, thank you. And I'm here to talk about the BMO Managed Portfolio Trust this morning. It's a listed fund of investment trusts. And so on the face of it, that sounds pretty uninspiring and probably doesn't have anything else but mediocre performance. But I'm going to try and show you this morning that the reality is quite different, and that this trust has definitely flown under the radar. It uses the investment trust structure to try and customize returns for income and capital growth shareholders of both portfolios, and the performance is quite strong. And I think for the retail investor, this is a trust that is genuinely worthy of consideration. So I'm going to start here on this just kind of summary slide, which tells you a little bit about the trust. It was listed in April 2008, with hindsight fairly horrendous timing, just before the great financial crash. And we had about 40 million of assets, and they all came from old investment plans that were held within our company. And we had about 2,300 shareholders on the day of listing. We've got a very active share repurchase and issuance program, and the goal there is to keep the rating of both portfolios, there's an income portfolio and a growth portfolio, keep them quite close to net asset value. And 13 years later, that has been pretty much achieved. The BMO retail plans, which own about between 60 and 70% of the trust, are a significant source of demand, and that's individual shareholders. And you can see there in the last 5 or 6 years, having had to buy in quite a lot of shares in 08, 09 and 2010, we've actually begun issuing shares, and you can see over the last 6 years now issued over £40 million worth. We were the rollover vehicle for a small investment trust called the KN Trust, which liquidated in December 2015, and 13 million of assets moved across to the Managed Portfolio Trust. And the assets now are around 170 million, with 15,000 shareholders. We have no institutional shareholders. We have no private wealth management shareholders. We've got hardly any private client stockbroker shareholders. It's all individuals, and the platforms, Hargreaves, Interactive Investor, AJ Bell, have been steady purchasers of our shares over the years. So just moving on here, some of the key attributes of the Managed Portfolio Trust, and our aim is to be a long-term savings vehicle for private individuals. And I said earlier that we've used the capital structure of an investment company to try and customize returns for shareholders. So we are a conventional investment company, but we have two separate portfolios, an income and a growth. And they are quite separate, except for one small thing, which I'll come to a little later, about income transfer between the two portfolios. But we've got clear objectives for them. For the growth portfolio, it's capital returns only, and long-term growth is what we seek. For the income portfolio, we certainly want a high level of income with some income growth and also some capital growth. So it's focused not purely on income, more on total return. And we listed in 2008, and we've got roughly about 40 holdings. There's 42 in the growth portfolio, and I think something like 39 in the income portfolio. So before I go on, I just thought it would be useful for me to just to spend a couple of minutes on how I go about constructing the portfolio, what's behind it, and what I look for in investment trusts. And so both portfolios have definitely got a global or overseas bias, although, as I'll come to later, I am actually increasing the UK component through more UK holdings because I'm quite optimistic about prospects for the UK. But I am part of the multi-asset team in BMO, and I get regular input from the global strategy team in order to understand the relative attractions of the Japanese market against the European markets, against the US emerging markets. And that's very important to have a template for that before I start picking stocks. And the key drivers for coming up with ideas and stock selections, yes, prospects for the relevant market or the sector a company is invested in. And I've just said I'm, for the first time for a long time, more optimistic about UK equity prospects. But the key thing that drives stock selection for this trust is asset performance over the long run, quality and consistency. So what we're talking about here is growth of assets. And I'm very keen to try and identify fund managers who can outperform, and even better if they can do so in a consistent manner. And one of the key elements of finding fund managers who can achieve that is regular meetings with them. And that is a key factor in the decision to buy. You get so much out of a one-to-one meeting. I'm very fortunate. I get to meet almost all the top investment trust fund managers. And you get a lot out of these meetings, and it can very much help if you're deciding whether to buy or indeed sell a stock. And discounts, whilst they are a very important element in the decision to invest, yes, I always try and buy trusts which are at as wide a discount as possible. It's important to note this is not the dominant factor, because actually discounts, I think, are not the dominant factor in terms of returns. It is asset performance in the longer run. And so that's key for me. And just one other slide here as to what I really look for in individual companies. When I say lack of quality research, that's perhaps not quite fair. There are some actually really good investment trust analysts in the sector, but it's just that lots of trusts are simply not covered. And so I have to do quite a lot of research work myself, and that can come about through attending conferences, whether that be in physical terms or virtually, reading research, and actually spending quite a bit of time analysing report and accounts. It might be a bit boring, but it is very useful indeed. And I thought I would try and convey to you what I look for in fund managers and what's behind that. And certainly process is very important. I ask questions like, is it repeatable? How does the fund manager apply their investment approach or their investment philosophy to constructing a portfolio? What is it they look for in companies? And what is their style? Can you actually get a feel for what they want to put into the portfolios of each investment trust. So process is important, so is experience. I like experienced fund managers who've managed the trust in different market conditions. And sometimes it can be quite adverse and they may not have great performance, but they've been through it, and that certainly helps when it comes to looking for forward returns. You look for resources. I think particularly important for overseas trusts investing in Asia, America, emerging markets. Do they have analysts? Are they locally based? All of that can help with stock selection. You need to get a feel for what is behind the fund manager. And then focus. And I think that's hugely important because so often you find really exciting fund managers. And unfortunately, within 2 or 3 years, they're not just managing an investment trust, they're managing a series of unit trusts, they're managing other funds, and suddenly, from perhaps managing a few £100 million, it's multi-billions. And almost always that results in performance gravitating back to the average again. So focus is very important. And I did mention performance there, and that's extremely important because that's what we're all about. It's trying to pick the fund managers who can generate performance. So regular meetings with the fund managers is absolutely key. And in terms of trying to understand the style and the process, which is important. So I'll just go back now to where I started off a bit earlier here. Performance. We've got very low portfolio turnover. The last 3 years, the turnover in the growth portfolio was 7%, and in the income portfolio, I think was 12 or 13%. So that means your average holding period is 10 years plus. So I try and run my winners where I can. Transfer of income between portfolios. I'm going to talk about that when I come on to the income side of the income portfolio. But we have a tight control of the rating and discount. The last thing I want is for shareholders in the managed portfolio trust to be trading themselves at a discount and investing in other investment trusts which may also be at a discount. So you don't want that. And we've largely achieved that. And actually, there's pretty good liquidity as shares because if need be, I will go into the market and repurchase shares, or if there's excess demand, issue shares. And we do that quite frequently. And then there's also once a year a conversion facility between income and growth, which is free of any tax implications. And that's become quite popular with shareholders. So very quickly, there's a chart of the discount of the portfolio, income portfolio since launch. And you can see there's been a little bit of volatility. Not sure what happened that one day in 2020 on the chart. But you can see from kind of 2012, 2013 onwards, we've generally traded at par or indeed a small premium. And much the same for the growth portfolio. And again, probably from 2013, 14 onwards, it's traded pretty much at par. And today, I think the growth portfolio is at a small premium and the income portfolio might be at a discount of 1. So the market makers understand where we want the shares to trade, and we go into the market and repurchase if the discount widens a bit, or similarly if the premium is a bit on the high side. Now, let's get on to performance because that is absolutely key. And a fund of investment trusts, which I said earlier, you probably think is pretty uninspiring. Well, I use the performance numbers through to the end of January. And you can see there, since launch, so that's very nearly 13 years ago, the All-Share Index, which is our benchmark and should be the benchmark for every UK fund, was up 87%. And the growth portfolio up very nearly 170, and the income portfolio 143.7. And so if you look at 5 years and 3 years and even 1 year, at the moment the growth portfolio is running well ahead of the all-share index, but actually so is the income portfolio. And I've included the 3 months to end January for you, because you will be aware that when the first vaccine was announced on the 9th of November, things changed in markets really everywhere, but particularly in the UK, and overlooked stocks, ones that have been badly affected by the pandemic, value stocks in general, have had quite a significant rally. And you can see that, the all-share index is up 16. But encouragingly, both the growth and income portfolios have kept almost in line with the all-share index over that time. And I'm quite pleased with that, and that's heartening. This is my other slide on performance, and this actually breaks down performance in every financial year. And we're at the end of our year is 31st May. And so if you just run your eye down, you can see the income portfolio has actually only underperformed the all-share in 2 out of 12 years, in 2018 and 2014. And the growth portfolio has outperformed the all-share index for the last 8 years consecutively. And you've seen the numbers so far this year. We're running about 15 points ahead of the all-share. So I'm reasonably confident that we might outperform in the current financial year also. So that hopefully is just to convey to you that we've actually achieved some decent performance in a relatively consistent manner. And now, income of the income portfolio. Remember, the growth portfolio does not pay a dividend. So the income portfolio, and I've just got here some information for you. The current yield on the all-share as of about 10 days ago was 3.05%. The yield on gilts, government bonds, was just over 1. And the managed portfolio trust has a yield of 4.6. And you can see our dividend record. First few years, we managed to maintain the dividend. Things were difficult in 08, 09, 10. But since then, we've been steadily increasing the dividend. We've maintained it for the first 2 quarters of this year. But the revenue position is quite strong at the moment. And so I'm hopeful that we might be able to look at increasing the dividend. It's the board's decision come the 4th quarter. And what I wanted to do for you, I mentioned earlier income transfer. And so what is that? And this is, I think, unique in the London market. I don't think any other trusts do this. And I just wanted to explain very briefly to you what it is. It has been hugely beneficial for both portfolios over the years. And what you see here is just, in theory, let's imagine we're on the 1st of January and the growth portfolio and the income portfolio are both worth 100. And actually, over the years, right through to today, the income portfolio has approximately had a dividend yield of 4, 4.5, and the growth portfolio of somewhere around about 1. It doesn't really pick stocks for income. But if you focus on the box that says growth portfolio, the value is 100 and it generates 1% of dividends over the year. And then cast your eye down, you'll see that becomes a -1. As those dividends are received by the growth portfolio, they are transferred to the income portfolio, who at the same time, the same amount is then transferred back to the growth portfolio in the form of capital. And so it's quite small. It genuinely is 1%, that's all. But at the end of the year, imagining everything has stayed unchanged, there is no dividend paid to the growth shareholders, but the NAV has risen to 101. And for the income shareholders, a yield of 4 has become a yield of 5, but they've had a slight reduction in their NAV, which is now at 99. But I can only tell you that has given me enormous flexibility as the fund manager. I haven't had to really go up the yield spectrum in order to generate dividends. And because if you go too high up the yield spectrum, that just smacks of risk. And we've actually managed to avoid that. So I think that's quite a strong underpinning of the dividend for the income portfolio. And it also benefits the growth portfolio. It's small, but I think it's quite unique. Now, let's get on to the portfolios themselves. And I've just got here the top 10 of the growth portfolio of the, sorry, I've got the income portfolio. Here's the growth portfolio. And here you can see what the top 10 holdings are. And they've got a big bias towards what you might term secular growth. That's the core of the portfolio. I take a genuinely long-term view. I'm not thinking about the next month or quarter or even year. I'm trying to think about trusts that will generate strong returns over the next 5 years. And if you look at where these trusts are invested, they're exposed to sectors that offer high growth characteristics over the longer term. So technology, healthcare, biotechnology, environmental, small cap growth across on a global basis, and private equity. And all of these trusts have not been bought and put into the top 10. They've got there through performance over the long run. And so if you could align yourself with some really great managers in interesting areas who pick the stocks, my word, you can have some fantastic returns. And the same applies to the income portfolio. And this is quite different from most income funds. You'll notice there's only one UK equity income stock there, Law Debenture, which I like a lot. I think it's a super company. But we've got quite different asset exposure. We've managed to get exposure to 3 quite exciting biotech and healthcare trusts. And they've actually got to be the top 3 through very strong performance indeed. We've got 2 private equity trusts in there, not normal for an income fund. And then we've got the Hypnosis Songs Fund, royalty income, which is also quite different. And so being able to pay income from capital, which some of these trusts do, has allowed me to gain exposure to asset classes that you would never normally find in income funds. And I think that's quite important. It's generated some strong performance for us, and it makes this quite different. And it's created a diversity of income streams as well, which also underpins the dividend. And let's briefly go through what I've been buying and selling of late. And you can see here in the growth portfolio, I've got Baillie Gifford European as a recent purchase. But one thing I've been doing really since probably the turn of the year is I've been gradually increasing my exposure to UK equity trusts. And actually, although you saw the top 10 of the growth portfolio, I have got quite a lot of UK and value-orientated trusts in the portfolio. Here's 2 I've increased, Fidelity Special Values and Law Debenture, but there's Artemis Alpha, there's Aurora, there's Henderson Smaller Companies, there's Henderson Opportunities, quite a lot of UK trusts. They're smaller holdings, but the plan is, because I'm attracted to prospects in the UK, to increase that over time. We've only had really the one sale in the last year, and that was Fidelity Asian Values. And in the income portfolio, similar story. I've increased my holding in Mercantile. A stock I've just recently finished buying is Diverse Income Trust, which is not yet on that on the presentation, but I have. And you'll see also a couple of higher yielding, what are called alternative investment companies, Supermarket Income REIT and Biopharma Credit. And I bought them last summer when I was concerned about dividends in general and dividends from trusts, which actually in the main have come through, not too many dividend cuts, but these are high-yielding trusts which serve to bolster our revenue account. And I've also taken a holding in the JP Morgan China and Growth and Income Fund, and that was funded by a sale of Utilico Emerging Markets. So let's just get on to what I'm looking at for the rest of this year and next. There's a number of points, and I'm not going to go through them all, but halfway down you'll see strong corporate earnings rebound, and that is definitely in the pipeline, and it will strengthen into 2022, and that is a positive for markets generally. Valuations, though, are quite high. They've moved above long-term averages. And in most cases, and I've got here that the US market is on a forward PE of 22 times. And actually, already that's come down to 21 times because earnings estimates in the US are going up quite aggressively. And you'll see that forward PE come down a bit as the earnings come through for US companies. But this is what I was saying earlier about the UK. We're on a forward PE of around about 14. But if we get earnings estimate rises and increases and strong corporate profits in the UK, that forward rating will fall. And it's one of the reasons why I'm attracted to the UK. So in terms of the portfolios, growth and income, I still favour core holdings in investment companies exposed to secular growth, because I think in the long run, that's where you generate really strong returns. In the case also, though, since Brexit and with that uncertainty removed, I think the outlook for the UK is quite interesting, and I've been gradually increasing exposure to UK trusts which are invested in mid and small caps in particular, because I think that's looking quite an interesting area. So I will just move on to this final summary slide for you. And I just want to say that we do very much have a long-term investment approach. Couple of points here. Growth portfolio has achieved strong capital-only performance over the long term, and it's very popular with parents and grandparents to invest for children. We have got thousands of junior ISAs, child trust funds and the likes. So people seeking capital growth for the long run, that's ideal. The income portfolio, 4.6% dividend yield, with some capital growth, has proven to be very popular with older investors. And just a final point or two here, and I produced this slide, first slide, a couple of years ago at the AGM. We got a well-attended AGM, and it's just really to say to shareholders or potential investors, these are some of the trusts that have delivered in the long run, and this is the reason why you should hold them. The Allianz Technology Trust I bought in May 2009, haven't touched it since then, and it's made 12 times the money. Polar Cap 9 times. Scottish Mortgage, even though it's down quite a bit today, has made 8 times the money. The Biotech Growth Trust. And I've got one in blue there, Chrysalis Investments, which I bought only a couple of years ago, and it's basically doubled. And that's a UK trust, private equity, investing in high growth companies in the UK. And so the message to me is, hold on to your long-term winners. Yes, I may top slice some of them at some point, but these are the trusts that will generate the strong returns for shareholders. And just to conclude for the income portfolio, obviously the numbers aren't quite as strong. They tend to be less growth orientated, but BB Biotech has tripled, and you can see some of the other numbers there. HBM Healthcare, which I only bought a couple of years ago, has more than doubled over that time. Curiously, the best performer is 3i Infrastructure, which you wouldn't have thought, but it's paid out some huge special dividends to shareholders, which are very welcome indeed. So I'm going to draw a line under it there and hand back to Callum.
Thanks very much, Peter. Thanks for that, very informative. And thanks to everybody for questions coming in. Please keep them coming. I'm just going to round up a few and say, because we've got a few on some of the more practicalities of buying the trust, about platform availability and things like that, and tickers. On some of the more prosaic things, we've actually just released a new updated note this morning, which you might be able to find, which might answer some of those for, specifics between the different tickers for the different share classes. But a couple have come in around the sort of liquidity and size of the trust. And you mentioned, obviously, the board and yourself are quite active in trading to manage the discount. But just level of assets and turnover daily. Somebody's mentioned that they were trying to buy and were having a wee bit of trouble actually doing it. But generally speaking, you find it's okay. I mean, do you and the board monitor for sizable orders? Because as you mentioned, a lot of them are retail. A lot of your shareholders are retail, and it's regular savings plans, fairly reliable. These are not big 100k tranches coming in necessarily.
That's absolutely right, Callum. It just isn't. The income portfolio is about 70 million in assets. The growth portfolio is about 100 million. And the levels of turnover have picked up. If there is, a large seller, and actually, I mean, the largest single owner owns less than 0.5% of the trust. And so he's just not going to get very large shareholders in this trust. It's spread lots of people who own 3,000, 5,000, 8,000, 10,000 shares. We've worked with the market makers to try and get spreads in, and they have tightened a bit. But if need be, I will happily buy in shares. We bought in some income shares a few weeks ago, 50,000, 100,000, issued 150,000 growth shares last week. And that's simply to meet ongoing demand. So actually the liquidity, given the size of the trust, you think, oh dear, this will be really difficult to trade. It's better than you think. That's all I'll say.
Absolutely. So a few others come in. One that's come in a couple of times here, which is clearly on people's minds, is just on the income transfer mechanism and if there's any tax liability attached to that, which I just think might be worth skirting over quickly.
Yep, the answer is no, there isn't. And the reason there isn't is because it's within one trust. Just think of it as a conventional investment trust, and that umbrella has two portfolios which are quite separate underneath it, but they do have this one link where the income is transferred, small amount, 1%, between income and growth, and capital transferred back. It has no adverse tax implications at all because it is within the one structure, the one vehicle. So that's the good news part of it.
I had a question coming specifically on hypnosis, which you obviously mentioned you've been buying. And the question was whether or not you think it's fairly valued to start with, and whether you expect it to provide a secured income going forward. It was the latter half of that, I think, maybe might be an interesting point to sort of start it off on.
Well, in terms of the income outlook from...
Well, just your view on the trust, I think your view on the trust generally, if it's fairly valued, but whether or not you expect that income to be secured, based on our recent conversations, I thought you might like to touch on that.
Well, yes, the answer is I do think so. I think it's probably slightly undervalued at the moment. It's gone to a bit of a discount, and that's maybe just a result of the fact it's had a lot of share issuance in the last year or two. And I think the market has kind of just wants to digest that for a while. But the reason it's had a lot of issuance is because it's buying song copyrights from artists. And there's only a finite number of those, and they are being acquired by other trusts and other private equity as well. So there's a bit of a land grab there. And I think that will go on for a year or two yet. But once that's completed, then you'll see the revenue being generated by the underlying portfolio, and it's already happening now. And if you just think of it as a play on streaming from Spotify and Apple Music, and of course there's a lot more of that. It's picked up, it's growing very strongly, and that benefits the revenue from the underlying song publishing copyrights that Hypnosis has. It's got other ways of increasing income through what's called syncing, which is kind of placing songs in TV programs and movies and radio and advertisements. Of course, revenues from live performances has reduced significantly and is obviously non-existent presently, but that will return in due course. So when artists play a particular song, obviously they get a portion of revenue from that. And so I think it's quite interesting outlook. And I've had it in the income portfolio from day one. I've also just bought it in the growth portfolio. There's only a few trusts, 2 or 3, that are in both portfolios, because I think the real story for Hypnosis is capital growth in the long run. And I think you will see the value of these song publishing catalogs increase in value significantly. And I think you will see quite strong capital growth from the underlying portfolio. So I'm excited by the outlook for it, and it's one I hope to have in for a long time.
That's great. A couple of questions getting at the same sort of thing. It's just about managing stock overlap in the underlying trust. Now, clearly, you're looking for sort of secular growth opportunities a lot of the time, as you say. Monks and Scottish Mortgage share a management house, for example, and there's going to be quite a few stock overlap. How do you manage for the stock-specific risk at the underlying level and monitor things like that?
Well, because I want a diversified list. I've set myself a limit of around about 40 holdings. We've got 42 at the moment in the growth portfolio and only 39 in the income portfolio. I think I can just about cope with that. But in terms of individual positions, I think somewhere around about 5 or 6% of the portfolio, once a particular trust got above that, I have to say I'd be looking to top slice it, because I don't want something becoming 10, 12, 15%, however good the trust may be, because that in itself manifests as a risk if something untoward were to happen to that trust or where it's invested. So I like to have decent sized positions. 4 or 5%, I think, is a significant statement that I'm keen on a trust, but I wouldn't let it get much beyond that. And I just like to have a diversity of holdings, because, I'm aware of the fact that it's only retail shareholders who own this trust, and you really don't want to have extreme levels of volatility. So, I do own the Biotech Growth Trust. That is a volatile trust. My word, it can perform. At the same time, it can be quite volatile. So you don't want an enormous portion of the assets tied up in that. But 2, 3, 4%, I think that's acceptable.
That's great. Couple of questions are coming just about use of gearing in the trusts and both the portfolios. And if you just want to touch on permissible gearing and then any actual use of it that you are deploying yourself.
Well, we can gear up to 20% in both portfolios. The growth portfolio currently has no gearing, and I could gear the growth portfolio. Some of the holdings are quite high beta, and markets have done reasonably well of late. So I don't feel compelled to, add more chips on the table through gearing. We are geared in the income portfolio, and something around about 7 or 8%. We've got £5 million of borrowings, and that is done for a quite different reason. It's not actually to do with the capital value of the trust or the prospects for the market. It's to do with revenue, because I've invested the amount of gearing into what are called alternatives. And alternatives are higher yielding trusts not exposed to equities. They may be invested in specialist property, wind farms, infrastructure, social housing. I've got 6 or 8 trusts, and they all deliver quite a high dividend yield, 5 or 6%. I bought a couple you saw in the activity there. Supermarket Income REIT, classic example. Biopharma Credit lends to pharmaceutical companies against the royalty stream from underlying drugs and products. and it generates a 7% dividend yield. The cost of borrowing is so low, we currently pay about 2% for our borrowing, and yet I generate something like 6% on average from that little mini portfolio. Hugely beneficial for the revenue account of the income portfolio, helps sustain the dividend, it's quite secure, and so from that perspective, I've tried to make it as low risk as possible, but it has been quite beneficial for the income portfolio.
I think that you've also just touched on another question we had coming in about property specifically, and how it's quite unusual in an income-specific portfolio not to see property in the top 10 at this time, especially. But if you maybe want to touch on your property holdings a little bit more, just a little bit more color around them.
Well, there are property holdings in the income portfolio. I've got one called Secure Income REIT, which is in the top 20, which is recovering quite strongly. And I've got a series of specialist property companies. So, for example, we have Assura, which owns a whole series, hundreds and hundreds of GP surgeries and small medical centres across the country. They own the bricks and mortar, and GPs pay an index-linked rent to Assura. It's a very solid company indeed. Good dividend yield. I've got Impact Healthcare, that's care homes, and it again owns the bricks and mortar. Somebody else runs the care homes, but it's got an index-linked yield also, somewhere around about 6%. And so we've got a number of supermarket income REIT I mentioned, obviously self-evident what it owns, and it's quite active in the market at the moment. And so there's a fair bit of exposure to property. Actually, in the growth portfolio, I've got TR Property, which, okay, it's had a bit of a tough time last year, but a fantastic record over the long run. Great manager, fantastic manager, somebody to stick with. So, yes, we've got actually more property exposure than you think, just not quite in the top 10.
That's great. Cheers. Had a couple of interesting ones in around the underlying technology exposure, and also one coming back to hypnosis again. It around interest rates, and so that's might be quite interesting to start talk about the general impact you would see from any. We're obviously seeing quite a lot of volatility in bonds the last couple of weeks, not been terribly beneficial for tech. On the other hand, not bad for maybe some of your protective strategies. How do you see it sort of balance within your portfolio, and how are you looking to sort of manage that kind of risk going forward, and what's your sort of outlook on that kind of thing?
Well, it's a good question. I mean, in the short run, I think you're right. If you get bond yields increasing sharply, then that's not good news for high growth companies or investment companies exposed to that, and that's mainly technology. And to be honest with you, a bit of profit taking wouldn't surprise me at all in the near term. And yes, I pay a lot of attention to it, but actually, if you try and fix on the longer run, then it makes it a little bit easier, because you understand that that's where you're going to get the growth in the future. And I do believe it's important to have exposure to these trusts. Now, it may be I decide to top slice some of them and invest more in some value-orientated propositions, perhaps as the year unfolds. I've certainly been increasing the value side of things through the UK of late, but I do think I do want to keep a core holding in what I would term secular growth trusts: healthcare, biotech, environmental technology. Now, I've also in the growth portfolio, which can be quite high beta, I've got between 10 and 15% of the portfolio effectively invested in very defensive trusts. And that's just to try and offset some of the volatility that was kind of implicit in that question, because I don't want shareholders to see the share price and the asset value careering around, in too much of a sort of volatile manner. So I've got personal assets, I've got Ruffer, I've got capital gearing, I've got the Rothschild Investment Trust, and they're all kind of not in the top 10, but they're there between 10 and 15% of the assets, just to provide a bit of ballast. should we get a sharp downturn and markets be down 20% in a quarter? I'm not suggesting they will be, but they could be at some point. And these types of trusts just offset what would happen to the likes of a Scottish mortgage, which would obviously be quite sharply impacted. I'd like to think after a 20% fall, I might be considering adding to Scottish mortgage in those conditions. But let's hope it doesn't happen.
Well, thanks very much, Peter. As you're aware, Peter, I'm under a lot of threats here to make sure we all round up in time. We're on a tight schedule today, so I think we'll have to wrap it up there. We've got quite a lot of questions still there, and I think we will try and come back to them all. Just to let everyone know again that we have pushed a new research note live today, which perhaps covers some of those, which might help your answer. But I think those questions have passed on. Hopefully, we can come back to everybody on anything. Thanks again, Peter. Good to see you. And thanks to everyone for joining. Thanks a lot.